Join us now, Priya Misra, who's a fixed income portfolio manager for JPMorgan Asset Management, and Carol Schleif, Chief Investment Officer at BMO Family Office. Get to you in a second for the equity angle on all this, along with fixed income. Carol, but Priya, start with you first. Does the Fed need to go up again, ever, in the near future?
I don't think so, but they can go one more time. I mean, what's 125 basis
why
points
bother?
among friends?
Are long rates unmoored now from the Fed?
I would argue the Fed message of higher for longer. The long end of the Treasury market heard it loud and clear, but this, I would say. This very recent move in Treasuries has been a little bit more dangerous. It's led by the long end. It's led by real rates. So we were already in the hard landing camp. I think the move in the Treasury market, the disinversion in the curve, I think that actually makes a hard landing a lot more likely. What stops this ultimately will be either some sort of financial accident or ultimately the lags do play out. We're not in the camp that the economy has become a lot more productive, that the economy can actually handle much higher real rates. You're looking at real rates 2.5% on the 10-year. That's going to hurt businesses. That's going to hurt consumers. It's just going to take some time. So, I do think we're nearing the end there. But, I would say volatility is high, conviction's extremely low. So it's hard to actually call the exact top.
Why do you think rates are running like this at this point? Is it because people look at the economy and think it's stronger and the Fed's going to push longer? Is it because they look at the deficits in Washington and think there's nothing that's going to get done there, that there's a chance, a very good chance the government's going to shut down now? What is it, just a combination of all those factors?
It is a combination, but I think ultimately, there has been supply for a while. Where's the demand? Why are the buyers stepping away? I think it's the Fed that's telling us we're not even close to cutting rates here. I think the Fed.
They're closer. Sorry to interrupt, but they're closer today than they. Don't you think? To cutting. I would change my whole dot plot chart at this point. Now I think rates might make sense next year because they may have overdone things, and this may get ugly.
Exactly. I think they may have overdone. They want a tightening in financial conditions. They're getting a very quick tightening in financial conditions. But look at the data. I think the Fed doesn't know. They don't know if the data is strong because fundamentally we've just become a lot more productive or a lot less interest rate sensitive. And which is why they're actually saying that maybe R star or this neutral rate is much higher. Or is it that the lags are longer? I would actually argue, the Fed argues that the lags are shorter because everyone looks at the market. I would argue the lags are much longer because everyone's locked in these low rates. So it's just going to take some time. Maybe it's 18 months from the start of the hiking cycle. We're right there now. So I think now is when interest rates start to bite. But I think the economic data is just slowing. It's not at recession levels yet.
Carol, none of this sounds great for equities. And we've been pointing out, it just happens to be the beginning of October and those horrible teens where so many times in the past, the good thing is markets sometimes bottom in the October teens, right. But usually there's some pain that gets us to the bottom before it happens. Is this history repeating itself?
Well, it's interesting. I would argue we've already had a lot of the pain, maybe not all of it, but you're seeing emotional overshoot in both markets, including the fixed income market. It is that compilation of events that are happening and psychologically driving that 10-year towards 5% or through 5%. It overshoots just like equity markets overshoot on both sides. But yeah, the September, October tends to be calendar-wise a pretty scary period. Hopefully what we have to pull us out somewhat will be a focus on earnings starting in a big way in the next couple of weeks. People will be listening really, really closely to what those companies are saying about their margins, their balance sheets, their cash flow. They'll be looking at a lot of things. It's interesting because volatile markets like this do open up lots of long-term opportunities, but you really have to have your seatbelt on.
Yeah. Priya, again and again, we've had people in recent weeks almost empathize with Jay Powell and the Fed because all they have are backward indicators. And they're no better, I don't think, than anyone necessarily at having a crystal ball. And you just, mentioned some of the things that go into their thinking. They're trying to decide, are we tight? Are we not tight? What's restrictive? What's not? How long is the lag? They got all these things trying to see into the future, but they don't know. And that's why they stayed too long in the first place at zero, because they didn't know. Now maybe they don't know again.
I sort of see your point. I think, it's an extremely uncertain environment. We're coming out of a pandemic. I think what the Fed maybe doesn't.
Still?
We still are. I mean, there's still, remember all those COVID savings? In our estimate, they're just running out now, which is why these lags might be actually a lot longer, because those interest rates didn't matter to me. I had the savings. As my savings run out, the job market now becomes a lot more important. I think the Fed has to be data dependent. They're telling us that. But I think some more humility, some more time. I think, they're continuing to do QT. They don't talk about quantitative tightening. I think that's part of this move. It's a lot of treasury supply.
That's a key, I think. Right? If
I think
they're not going to be the buyer, who is? Right?
Exactly. I think the Fed is ignoring that QT has an impact. QE had such a big impact. To argue that QT is not tightening, they're tightening every single day. Whether they hike rates or not, they're still doing QT. Plus, they're telling us, well, we're not going to cut rates at all, for a pretty long time. I think they're tightening through what they're saying. They're tightening through QT. I wish they would just give it some time.
Carol, 2023 might end up being a year to forget, at least for the Dow. We're now down. I mean, the NASDAQ's done well. Will 2024 be a positive year for stocks?
We definitely do think you'll see some incremental gains in most stock markets. And it's important to remember the S&P is still up 10% for the year. The NASDAQ is still up 20%. And granted, off of low levels coming in from last year.
It's only October.
Hopefully the Fed does hold in here and takes that extra potential for a rate hike off the table, because basically the market is doing that hike for them. It's hiked once or twice just in the last week or two when you start looking at the leveling of that yield curve. Hopefully they haven't gone too far and we can have a lot of stability, because on the other hand, you do have some fiscal stimulus still headed into the market in the form of a lot of the acts that have been passed and the construction we're doing and the workers. And one of the reasons why the market freaked out yesterday was the more solid labor market, which indicates that there's still some base underneath the economy, that we haven't fallen off the cliff yet. And we do hope that, and our base case is that we believe next year will be a pretty reasonable year.